Welcome to Markets Now. I'm Michelle Rook along with John Payne with Hedge Point Global Markets. And we're seeing lower livestock, grains, all to the plus side here. Soybeans have been the price leader this morning, John. And how much of that is South American weather concerns versus ideas that we're going to get more export business off of it?
Well, I think both. The South American weather problems are going to lead to more export business for the United States. I think in the short run here, short covering really is the soybean story. You've got a lot of short sellers here in Brazil, and then an Argentinian election on the horizon. So there's a lot of uncertainty, I think, with the South American conditions right now. We're in that period of time. We can go back to maybe May or June in the United States where we're planting and things look dry and outlook for yield isn't there. So I think the price is going to come in rather quickly here. The story and the difficulty will be from a trading perspective is, do you sell into it or not, and at what price? And for us, that's kind of what we're trying to prepare for. The markets from a standpoint of long-term demand kind of worry about recession and currency with the dollar, but in the short run, there's a lot of short sellers that have based their thesis on a large South American bean crop, and then maybe more importantly here, a large South American corn crop that's going to follow the beans. The beans can be saved because they tend to grow their beans. They can grow their beans longer. They've got a longer season, and they could really plant in January if they have to. But when they do that, they won't plant corn. So you've already seen a couple of firms write down just some small amount of yield based off planting conditions going south. And I think that'll be something we continue to see here throughout the winter in the United States.
Yeah. So, when will corn start to follow or take notice of this? Because corn this morning, obviously hitting some new tier lows and finally bouncing. So we could score a bit of a reversal here, but what's your thought about that?
Well, it depends on the contract. I think the near dated contracts, I kind of have told folks $5 would be a nice target for the December. If you can maybe get lucky here, March, maybe that would be where you look. The longer one is the May, and the May and the July for me would be where, you start to see some Q2 buyers, Q3 buyers on the commercial side in the United States. Things pencil very well here. And I think a lot of folks have seen prices fall and they're saying, hey, well, I'm not going to buy until I see a bottom in. They need to secure supply. They want to secure margin. And so at this point, I would say you probably want to look to be a little more aggressive on those contracts from the buy side. From the sell side, I'd be maybe patient for the summer, just given that the U.S. still has to plant. There's a lot of things that can happen, but maybe a little more aggressive on the sell side in the March. Selling into these weather rallies is always difficult. You and I will talk about how bad things are, for call this summer. The market rallied on a lot of poor weather news, and then all of a sudden it rained. And so, this is an uncertain gamble you have to make. I think the price will incentivize you to at least step your foot in the water. And I don't know if we're there yet, but for those Q2, Q3 contracts, looking at May and July, I think we need to go a little higher here before I would be selling, just because if you can afford to hold it, I'd hold it. If you can't afford to hold it, cost of carry is going to eat you alive all the way out to the March, especially in the corn and the wheat contracts.
Yeah. And I wonder, would corn be up as much as it is today if soybeans weren't up as much as they are?
That's a great question. I think the corn has a bullish story in its own right. I think a lot of that's, global demand, Japan being a big part of that. Soybeans, I think, are a little more of a weather story, a positive crush here in the U.S. So I think they can trade kind of independently here. It's nice to see beans, especially in the deferreds like November of 24. I think that will pull the D's 24 higher for corn. But as far as the near dated contracts go, I think corn's more of a wheat trade. Although I will say soybean meal being higher, trading nearly contract highs as we go into D's delivery just a couple of weeks away. That's a bullish sign, I think, for feed, and one that I wouldn't ignore if you're a feeder here in the U.S.
Okay. So you mentioned Japan. So let's talk about what's going on over there, especially with their interest rates climbing and what it might mean for corn demand. We have, Japan's a big export market for us.
Yeah. And for me, I've been doing this for 17 years now, kind of following the markets day to day. And Japan has been a story in a country that can rarely largely be ignored. It's got zero growth, zero inflation, negative interest rates for the longest time. And, I have a colleague that I work with, Matt Connolly, who's thankfully one who has been around when Japan was a giant in the markets. And he recalls going over to Tokyo and, getting a lot of business those days in the late 80s. This is the first time. And I mean, you're seeing, the yen potentially want to increase and appreciate versus the USD for the first time in almost 30 years. So, that throws a monkey wrench in a lot of issues. Asian demand, who's going to be able to buy at what price? What did the Koreans do based off of that? So in my opinion, this is a kind of a currency market that, we'll keep an eye on. If Japan would grow at a rate that, would maybe even rival what it was doing in the 80s or even close to it, I think you could look at some serious organic demand coming to the United States. They're a big trade partner of ours, especially if South America and the Brazilians don't have it. I think that's the big concern, Michelle, is that we've had, U.S. demand has been supplanted by, in the late 2000 or late 2010s by Ukraine and Black Sea, and then in the last couple of years by rising supplies out of the South America region. At this point, we might see neither this year. So it's a little bit scary to kind of go out here and sell the 24 at this price, but say you can get some accumulators up around $5.50, $6, that's where you maybe look to start. But at this point, I'm willing to let it ride a little bit here and see what the weather does. The midday model runs just came out for Brazil, and they were dry. So, Japan, Korea, and China have all been buying a lot of South American supply. And so if those folks need corn, they're going to have to come to the U.S., especially, the later part of the summer.
Yeah. And of course, wheat this morning, we're seeing some short covering, just following corn and beans. Is that all we're getting?
Yeah, I think wheat's got some story into the South American yield side of it, but in reality, I just worry that, wheat is a financing mechanism right now for folks who have it. They need to pay bills. Wheat and storage is the way to do it. You've got huge carries. I mean, I think we're like at a 50-cent carry between now and May. So, in my opinion, that's the market that you're probably going to see dictate, where folks look to raise cash if they need it. And in reality, these weather problems in South America and in Australia could be, easily supplanted by increased yields in Russia and maybe even the Ukraine. I don't want to get too into the weeds on what's going on in the war over there, but if you can read the tea leaves through a lot of the articles we've read, there's a Time article out this week that was pretty bearish on things happening over there. I wouldn't be shocked to wake up one morning and see that, we've seen at least a ceasefire or some sort of pause in what's going on over there. And that's really what I'm most concerned about when it comes to grains.
Because definitely that could be a vacuum then.
Oh, that would be very bearish, at least in the short run. I think a lot of what's holding corn up here and wheat up here is the fact that there isn't supply coming out of, or at least growth of supply coming out of the Black Sea. And if that would change for whatever reason, and I don't know, I'm not smart enough to be able to predict how the thing would shake out, how the war would end, what would happen. But I would imagine, if things calm down from a military standpoint, there's supply that could easily move out of the Black Sea and move into China and move into those areas in Japan that I mentioned if, conditions with Russia would normalize. So we're a long way away from that at this point. But again, I kind of read the tea leaves here, especially what's going on in Israel. We had funding passed last night from the House, and it was, I thought they would tie the Ukrainian and the Israeli funding together. They didn't. And now it looks to me like there's a lot of questions to be answered before we send another blank check over there.
Yeah, a lot of uncertainty and the moving parts for sure. Okay,
Yes.
cattle market. As I said, we're a bit lower here today. We've had a nice run. We got above and field chart gaps yesterday, closed above them, but we're getting a little cash trade. It's better, but yet the market's setting back. Is this just some profit taking then?
Maybe a little bit. I think that, we have a saying around in our parts here, you chase headlines, we're going to sell newspapers. Because in reality, you look at where we are on the cattle side, just from the cattle on feed report, was that 2 Fridays ago? And we're right where we were before that, maybe a little bit cheaper. But, in my opinion, the vol run has happened. I don't think that the sell side cow-calf guy is going to be out here selling too much ahead at these prices. In fact, we saw, if anything, they're not willing to expand the herd. So I think the deferred contracts will stay higher. On the fat side, look at where the premiums tend to lie on the April fats versus the cash. And if, let's quote cash at 185 today. I've heard that that's a little bit higher than that in the southern part of the country, as you got some deep-seated feeders that aren't looking to sell, below 187. And I think you look at a $4 to $5 premium. That's typically where we sit on the April above the cash. And I think right now we're basically even. Earlier this week, we were at a positive number. So I think, the fat cattle markets will find a level here, continue to trade. I think the one big concern here, and we'll watch Tyson earnings next week, those will be keenly watched in regards to how the profit margins are for the packers.
Yeah, not only on cattle, but obviously we're going to be watching earnings on hogs. Let's talk
Yeah.
technically about this hog market. We got above these 50% retracement levels and resistance. Today we're setting back here. So just taking a little pause, you think?
Yeah, I'm a little bit skeptical that we've got a whole lot more to go, at least on the
Yeah.
D's. The Feb as well. I think you maybe get up towards to that 80 cent price level that you let them fly. There's still going to be some liquidation from what I've heard coming from some of the bigger players in the game. They need to get skinnier given the interest rates that we're in, and I do think the summer markets look very good, but I think the near term prices probably are a little bit where they need to be relative to cash. We expect cash to continue to come off. But in reality, I go back to the Asian market, specifically Japan, huge pork, maybe not a pork importer of the U.S. from a degree of what China would be, but still a big pork user. And, that puts a lot of pressure on competition over there. So I think in the longer run, pork markets for me are, kind of the interesting story. I attended a seminar a couple of weeks ago, and, the gentleman said nobody's buying pork ahead. And that kind of baffles me that, you've got beef up here near $300, and if you could secure some couple of years worth of pork demand, if you're a restaurant or an end user, there's some value, I think, there is just given that the U.S. inflation story doesn't seem to be done yet.
No, that seems like a really good point. All right. Thanks for joining us, John Payne, Hedge Point
Thank you.
Global Markets. That's Markets Now.